Dr. Trader is back. Gold has pushed into its highest area in more than 3 months. On the chart alone, the trend looks unusually clean. Daily, weekly, and monthly structure all point higher. But this week's problem is not predicting direction. It is deciding whether a bullish view still offers a good entry when price has already advanced and U.S. real yields remain high enough to pressure a non-yielding asset. The framework carries a bullish bias over a 3-week horizon with low confidence. The practical decision is not to chase. For traders without exposure, the better response is to wait for price behavior around weekly VWAP and the U.S. data cluster. For traders already positioned, the structure has not produced an exit signal, but position size should reflect event risk and the absence of additional confirmation from liquidity and sentiment. At the locked market snapshot, gold traded near 4,641.1. Weekly VWAP was 4,628.06. Price was roughly 13 points above that level and testing it from above. This is the nearest momentum support, not structural invalidation. Sustained trade lower than VWAP would show short-term momentum turning against the bullish thesis and would justify reducing exposure. Weekly TrendSL sits much lower at 4,490.23. Only a weekly close lower than that level would invalidate the bullish structure and require the longer horizon thesis to be rebuilt. Gold is being supported by 3 observable forces: aligned price structure, concern about the U.S. fiscal outlook, and a dollar that has not produced a convincing recovery signal. DXY carries a bearish bias this week, but the separate dollar framework is standing aside, so dollar weakness cannot be treated as strong confirmation. The defensible mechanism is narrower. A softer dollar reduces friction for gold priced in other currencies. The available evidence does not establish a direct transfer of capital from dollar assets into gold. Positioning adds weight, but only within clear limits. The available COT reading for COMEX gold futures and options leans positive and agrees with the bullish price structure. However, the brief does not provide the exact report week, cutoff date, or net position figure. A referenced historical test covered 41 activations and reported a favorable result around 70.7%, but the full methodology and test period are not available here. COT and the backtest therefore remain supporting evidence. Neither one is a trading trigger or a promise of outcome. The strongest counter case is the U.S. 10-year real yield at 2.35%. When investors can earn a positive real return from government bonds, the opportunity cost of holding gold rises. Gold advancing despite that pressure suggests fiscal hedging demand is currently outweighing the yield mechanism. It does not remove the risk. Hotter inflation data or a more hawkish Federal Reserve message could push real yields higher and generate a sharp pullback. Rising call option demand can amplify that move in either direction rather than guaranteeing continued upside. That leaves 2 clear paths. Bullish continuation requires gold to hold weekly VWAP through core PCE, preliminary GDP, and the Federal Reserve communication, then build demand above the weekly balance zone. The risk path begins if price loses VWAP and cannot recover it, showing that short-term momentum has shifted. The final structural boundary remains TrendSL at 4,490.23. Only a weekly close lower than that level would fully invalidate the bullish thesis. Until one of those conditions resolves, the bias remains bullish, but the decision is wait or keep exposure conservative. View the updated research and performance record at Intermarket Edge. This material is informational only, does not promise returns, and is not individualized financial advice.